This week, we're talking about taxes.
Taxes.
We're talking about taxes. There's a lot to talk about taxes. We know that there is a whole bunch of people talking about what Florida's doing with taxes. From a legislative standpoint, right? Like our taxes going away, property taxes going away in Florida under this like DeSantis administration. There's also a whole lot of talk about the last 5-6 years in Florida and how taxes have affected us. We're going to hit that. And then we're just going to talk about taxes et al. You know, just kind of like how it affects the rental property investors' mindset. Welcome everybody to the Tuesday edition of your Not Your Average Investor Show. First draft. This is the first draft. What is it? Friends and Families Night behind the scenes of the new JWB studio. We're testing this out ahead of the 500th episode next week. I'm your host Pablo Gonzalez. With me as always in the new JWB studio. First draft. Friends and Family Night. Not totally ready. I'm not going to be this like horribly lit from now on. The man that I actually like to call GC because he's got the genius concepts, because he knows how to generate cash flow, because he's a great co-host, and also coincidentally because his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Fantastic to be with you here in the new studio.
Yeah, let's just tell everybody about this like studio, right? We are in JWB World Headquarters. JWB, as everybody knows, has moved into the downtown building, buying in on this downtown renaissance that you guys are kind of at the tip of the spear on. The team, how long has the team been working out of this building now?
We moved in February,
just in time for the summit.
That's right. 3 weeks before summit.
3 weeks.
That was exhilarating.
That was, you know what else was exhilarating? The last minute tech setup of this studio this morning.
Oh my God. If you guys could have seen what this was like an hour ago, you'd have been impressed that we're here right now.
Yeah. So as you know, we have our 500th episode coming up next week. So we want to be in studio for this. So this is kind of like a first run tech rehearsal. We could have done this. We could have done it out of like a conference room if we really wanted to. But no, we wanted to do it in here so that we have the 500th episode. GC, we were just talking about the 500th episode this morning, and you brought up this thing about like, what else have you done 500 times?
Yeah, I started to just think about doing something 500 weeks or 500 shows, basically, I don't know, 300, 400 weeks in a row. Yeah. And there was, I think, a 3 to 4 year stretch for you where you never missed a show.
Yeah.
For like 3 years.
Yeah.
And I missed a couple here and there. So we started thinking about like, what else have we done in our lives that we have been this consistent and showed up and enjoyed? And there's not many things. The only thing I could think of for me is that I have told my wife and my kids that I love them consistently and that I've shown up for that. Beyond that, I don't know if I've done it. I mean, I love going to church. I haven't gone to church 500 times in a row. And so what a special gift, I think, really it is to get to 500, to be here with you, to be here with the community, man. Never knew that it would become what it is. And just
it hasn't become that yet. So don't count your chickens before it hatches. This is $4.99, GC. Let's not get too ahead of ourselves.
It's true.
Let's not get too sentimental, but we got something really special in store for the 500th episode. So call your friends, bring them on, right? Like you're going to want to be there for that. But today we're talking about taxes, which, by the way, I don't know if 500 episodes, I'll tell you, every time we talk about taxes, Gregg comes with a new, sparkle in his eye. It's a new gusto. Gregg likes to talk about taxes. Gregg,
I do.
You want to tell people about your love for taxes?
I mean, I'll tell you, usually reducing income taxes is what really gets me going. Property taxes are something that I would say is probably a little less exciting for me personally and a little less exciting for the average investor. Except for the last few years. We all love to talk about property taxes now because there has been a lot of noise about the potential for Florida to remove or significantly reduce property taxes. And so it's funny because when we talk about how important inflation is, and we related it back to the COVID time, before COVID, I don't think anybody ever asked me about inflation. I mean, I love the benefits of rental property investing because it's a hedge against inflation, because you can profit from inflation. And it's really how you win long term. Savvy investors understand this, but almost no investors want to talk about inflation prior to COVID. And then all of a sudden, inflation was 9%, and then people are just talking about inflation.
Yeah.
So now there's a little bit of a similarity here with property taxes in the state of Florida. Nobody really talked about property taxes for the longest time that I've been investing for almost 20 years now. But in the last year or two, it's been something that we need to keep on top of because there could be some potential big changes coming down the pike.
So let's start with the big headlines, right? Everybody knows that Ron DeSantis has kind of like brought forth this idea of eliminating property taxes in Florida. Then we're just going to talk about historically, right? Like this idea, we hear it all the time in investor rooms. Florida taxes are insane. Don't invest in rental properties of Florida because taxes are crazy, right? So we're going to talk about that. And then we're going to just talk, let's just lay down some data, some perspective, just really understand what piece of the pie property taxes represent when it comes to your return, when it comes to your cash flow, all these different kinds of things. But let's start with the sexy headline, GC. What do you think?
All right, let's do it.
Give the people what they want.
Give the people what they want.
The sizzle, and then we'll end on the steak. So early 2024, we went into what would we call the study phase, right? There was a proposal to just kind of like not direct elimination, but study what it would look like to eliminate or reduce Florida taxes by the governor. Then late 2025, at that point, we started, it pinged. We were just kind of like, oh, this is a funny little headline, right? But like not really taking it very seriously.
I think, we did a show on it, or one of the segments was on it. And I think the lasting thing that we probably said or kind of left with as a thought was like, this would be big if this was going to happen, but there's a lot of obstacles to get here. We don't even know if this would be a good thing or a bad thing. We don't know how we'd pay for it. So nice to talk about, but probably one of those headlines that we have sometimes that we need to address, but we didn't really think it would be something that we'd be addressing a year, 2 years later at that time.
Yeah, not to draw a light parallel to COVID, but I remember 2 weeks before COVID hit, we're like making jokes about it, and then all of a sudden it's real. Right?
Did not see that coming.
Did not see that coming.
No, not many people did.
But yes, anyways, these outlier things can happen, right? Like black swan events happen. I would say that if this really came true, would be a black swan event. I don't think you, in your history of investing in Florida real estate over the last 20 years, you thought there was going to be a moment where there might be a reality of property taxes going away.
No.
Okay.
Not on my radar prior to the last year.
Cool. So we didn't take it very seriously. And then late 2025, it hit this like fast track shift, right? Like it started going from like a study into action. And it wasn't just a simple cut. It was framed as this like 10-year phase out of ways to do this thing. And then all these different kind of like versions of it started like circling around. And it started bouncing around in the House and Senate and whatnot. And right now, early 2026, we're really at this point where there is real legislative momentum. There's real public support, somewhere around 56 to 58%. But there's a little bit of conflict that's going on. GC, you were kind of telling me the story behind the story of what's going on in the back there. You want to give me that summary again?
Yeah, I can. I'm going to do my best here. This is not my area of expertise. So I'm probably going to screw up a few of the details here. But, at the end of the day, there is real momentum to get this on the ballot in November. And that's what the governor wants. And now it seems like both the House and the Senate also want that to happen. The majority of the House and the Senate want that to happen. What has happened is the House put together a bill. So an actual plan to do this. It was to either completely eliminate or significantly reduce property taxes not associated with schools. And so they put a plan together to do this. The Senate hasn't. And the governor really hasn't commented on the House's plan. So now we have the House who has put a plan together and saying, hey, we're actually doing something about this. They're saying, hey, Senate, why don't you take our plan and agree to it or come up with your own plan? Hey, governor, you've been talking about this for 2 years now. There's something to do. And so now they're voicing some frustrations because it hasn't moved forward since then. The governor has, there's obviously things that have to happen before it goes on the ballot, including having a plan and then, talking about it, refining it before you get it on the ballot. And the governor has other legislative sessions that are preempting the property tax discussion. So the governor is really confident that he can get it on the ballot by November. It seems to be pushing in certain directions. You got some squabbling happening between the House and the Senate right now, but it looks like there is probably going to be something on the ballot come November that is either eliminating or significantly reducing property taxes in the state of Florida, and we'll just see what the voters think if it gets there.
Okay, so House and Senate kind of like fighting for, it's like your two kids going for like, this is the rules I want, this is the rules I want kind of thing.
It doesn't really seem like they're fighting so much right now. It just seems like one is saying, "Hey, I'm doing something about this," and the other one is saying, "Hey, I'm going to take my time and I'm going to do this the right way."
Yeah.
And so the one who is doing something about it is saying, "Why don't you do something?" The other one's saying, "Hey, we need to think a little bit more about this."
Got it. Sounds like the elder sibling and the younger sibling.
Yeah, exactly. Right.
Like,
You know,
they-
in terms of political squabbling, this seems very, very tame, to be quite honest. But you know,
yeah, yeah.
That's what the politicians do.
That makes sense. And then GC, you were telling me, right? Like we've talked about as time has gone on, there was kind of like, this is going to be a tourism tax, then it was going to be a sales tax. And there's a little bit of nuance around kind of like who we want to foot this bill from, like from the governor and from like from the legislative bodies. You
Yeah.
tell me a little bit about that.
Yeah, it seems like there's actually starting to be a little bit of kind of um I guess plan, and there's numbers behind the balanced budget if this was to happen within the House's plan. So it's starting to actually take a little bit of form.
Mhm.
The big question was, how are we going to pay for this?
Yeah.
And in the House's plan, they largely said that they were able to eliminate a lot of government waste, which I think we can all agree is a great thing. And then they significantly reduced property taxes through their measures, and they also included a sales tax reduction,
Mhm.
which is really interesting. And what Governor DeSantis has said, and there's some squabbling about how big of the deficit would need to be made up if property taxes were eliminated. So there's not a finite number there. But what Governor DeSantis has mentioned is that he really doesn't want to have a sales tax decrease because we're going to have to make up for the services to be able to pay for the services. So, instead of giving a sales tax, which basically benefits anybody who comes in and spends money in the state of Florida, he's very pro on reducing expenses for Floridians who live here. So he is saying, hey, let's move some of that money from the sales tax decrease and buffer the property tax decrease. So those revenues can go there and make the property tax elimination much easier. They're kind of course, we'll go back and forth on that.
Got it. So he's like, my stakeholders are Florida residents, right? Instead of like figuring out how to make this a consumption tax or not a consumption tax, it's like, let's make this something that people, Florida residents aren't necessarily going to pay for, right? But it also isn't just like a tourism tax because Florida residents benefit from tourism,
Right.
and we don't want to just kind of like diminish tourism either, right? So there's like some nuance there, right?
Right. Yeah. The plan is not to increase the sales tax,
Yeah.
which would, in essence, maybe diminish tourism and other spending. But the big hang up is, how do you do this equitably? If you're going to significantly reduce or eliminate property tax in the state of Florida, how do you do it equitably for the varying counties that we have, varying sizes of counties, varying economic realities for our counties? Some are, economic powerhouse
tourism, some don't.
Right. Some live off of tourism, some don't. Some are economic powerhouses and some are not. And so especially for the smaller, more rural counties, they depend almost entirely on property tax revenue coming in to fund their services. And if you're a small town, you still have to have a courthouse, still have to have a firehouse, so it's like, you can't just like scale down some expenses.
Totally.
And so if you eliminate or significantly reduce their revenue stream, how do you do that fairly? And so they don't have an answer for that yet. That's what the Senate says that they're, attempting to figure out and to do it equitably. But one thing that the governor did mention, which I thought was really interesting, is that he's very big on benefiting those who live in Florida, and he wants to make up whatever deficit there would be from a property tax elimination or reduction for those international buyers who are buying luxury homes in Florida. So an additional tax on luxury purchases from international buyers has been talked about. And then just talked about how he would rather have folks that are coming in as tourists being able to spend and to be taxed as they currently are right now with the sales tax.
Benefit the local business.
And then, the Floridians who live here would see the reduction of property taxes, which is, we are his constituents. And so that's a lot of the rhetoric that is being floated out right now.
That's when you told me that, I gotta say, I'm pleasantly impressed with the strategy, right? Like,
Okay.
I think that there's a real, as somebody that understands the international market in Florida, right? Like somebody who comes from that world, right? Like there's very much a inelasticity to the luxury market that comes from South America and that comes from Europe here.
Mm-hmm.
And those folks, they're not going to get like they're looking at this like it's not a hey 3-4% decision for them. For
Right.
them, it's like I'm getting away from like
In.
hyperinflation, or I'm getting away from an unstable government or whatever. And it's generally this like multi-generational money that doesn't really like isn't super price sensitive in that regard.
Right.
And I would say that if you're really taxing the international buyer inside of Florida, for that's going to be a luxury market. So you're probably going to get like the total revenue you're going to get for increasing a little bit of taxes on that person that is inelastic, that is coming here for other reasons, that's like a blink of an eye to them, while keeping the stakeholders, which are some counties that really are, rely on the tourism and rely on the local spending, other counties that really rely on property taxes or whatever, to be able to even that out feels like a pretty good balance of kind of like serving the stakeholders of the state.
In theory, sure.
Yeah.
I don't know. I don't know what the real numbers
Yeah,
are.
yeah, right.
I don't know. I
Yeah.
mean, I think there's a lot of theories here that could play well to take care of those in the state who are struggling with affordability, because that is the reason, that is the big pitch to do that.
Yeah.
And then to have others who are outside of living in Florida who like to enjoy either property or services be able to foot the bill. I think that sounds great to every constituent who's living in Florida.
Yep.
I don't know how you do it. I mean, the deficit still, to me, sounds quite large. So, and we still don't know exactly what the numbers are. They're sort of congealing, but they still, I think, probably have a lot of holes in them. So, yeah, I would say it's a cool idea.
Yeah.
I think there's still a whole lot of numbers that we have to really like look through, because the downside of doing this, the upside is great for the state of Florida.
Yeah.
More affordability for us as rental property investors. We would win dramatically here, because while our property taxes would not be eliminated as rental property investors, what would happen is market values overall would likely increase, and your home's value, your rental property value, would likely increase, because home values would go up for those primary homes. And so rental properties would follow suit, and rental property prices would go up as well. So that sounds great for us. But the downside of a strategy where you eliminate property taxes is we might lose some of our essential services. And so that's a pretty big downside. So I think looking at the numbers and making sure we do it the right way is important to make sure that it's a good thing for everybody. Like, honestly, not just us, not just me and you and those who are watching the show here.
Makes sense, man. It's definitely going to be like a thread of a needle that's going to have to happen in order to like do something. So, I think the word extraordinary, it like fits here, right? Like it doesn't necessarily need to have a positive or negative connotation. It's just extraordinary.
Yeah.
Right? Like this is not your average move here.
That's true.
State, right? Like,
that is true. And property taxes are a lot. The state has a surplus. So I applaud the idea and the ingenuity. And honestly, it's gotten a lot closer than I ever thought it would be. Yeah, so I hope that the numbers can work and everybody benefits.
It's gotten closer than I ever thought it would be. I like it more than I ever thought I would like it, based on like what they're saying. So that's pretty cool. And at the end of the day, yes, if we're just going to like segment my rental property investor brain, like this thing happening would be really phenomenal for my returns, because I know that my home price appreciation is going to go up across the state, including Jacksonville, on top of all the other things that are going to happen in Jacksonville.
The only state in the country with no state income taxes and no property taxes. How many people are going to want to move to the state of Florida? It's going to be a lot.
Yeah. Yeah. All right, cool. So that is that's the state property tax discussion, which we've now hit on a couple different times. As it continues to evolve, we'll continue to talk about it here. Now there's another discussion, right? There's this idea that, as you know, I travel the country a lot. I go to a lot of different conferences in the property management space, and talk about JWB and all the great things that we're doing in Jacksonville. And I used to get, well, I still do, I guess, right? Like you get a lot of this, like Florida, you're investing in Florida,
right?
Aren't property taxes going crazy? Isn't property taxes killing Florida rental property investors?
Yeah.
Right. So we want to take a moment to dive into that piece. And for that piece, everybody here is going to get the classic GC presentation here that he likes to put together for you. GC, you ready to show this
Let's
thing?
do it, baby. Let's do it.
All right, let me see. All right, this is new studio, everybody. So I got to figure out how I'm going to share my screen.
You're doing
I
perfect.
promised myself
You
that I
are
wouldn't
so good.
lean into the look at this. It's happening right here. It's almost like I've been here before.
Well-oiled machine.
So like a well machine. So we're gonna put into perspective kind of like the effect of the rise in property taxes over the past couple of years here in Florida. That being said, these are past numbers. This is informational purpose only. Your investment, do your own due diligence. All investments require risk. Anything else?
We're not financial advisors. This is not financial advice.
No financial advice. All right, cool. And of course, JWB team is here for you. If you want to help in investing in rental properties here in Jacksonville, go to chatwithjwb.com and pick a time, or you can call JWB at 904-677-6777 or text only at 904-293-0341. All right, GC, let's get to the meat of this thing. Talk to me.
Cool, man. Well, I just thought it would be good to have real data to substantiate the uproar for Florida property taxes. I will just give a little nugget here. In all of my years, I never thought that property taxes would be something I would hear about a lot, you would hear a lot about, as a reason to not invest in the state of Florida. Because big picture, what happens when property taxes go up, it's another way of saying you saw substantial home price appreciation.
Yeah.
I mean, that's really what that means, saying it another way. Now, the property tax increase hits us in our pocketbook that year.
Yeah.
But there's a lot of other things to consider too. But the bigger picture, I never thought that would be a reason to not invest in Florida, because the alternative is the hundreds of thousands of dollars of additional home price appreciation you get when you have substantial property tax increases. So yeah, I think this whole conversation is kind of out there for me. It's hard. I didn't see it coming. I didn't see it coming. Yeah. So, but I do think that it's important for us to substantiate what really has happened when it comes to property taxes, because even though you make a lot of money when your property taxes go up, when you think about home price appreciation, you don't spend your home price appreciation, right? It's a lot of times it's in your property. It's not in your bank account. When property taxes go up, it hits your bank account. And that's why people are way more sensitive to it.
As somebody, man, I remember when we were first kind of like just scheming up this show, 499 episodes ago.
We're not there yet.
And we were just kind of like talking about like, you're a very numbers focused guy, right? Like, your numbers. You invest in this asset class because of its kind of like how it pencils out and just like how obvious the returns are and all these different things. So I could see how like such a logically minded person like you would obviously be able to derive the conclusion that like, yeah, if my property taxes are going up on one side, it's because my home value has gone up on this side.
Right.
And that's never going to be kind of like, you're always going to like, this has leverage. This has all these other things that are going up that are not one-to-one, while this thing is just like inching up this way. So I could see why you would never, like the shock that you're describing of like, I would have never assumed that somebody would say like, well, property taxes, right? Because it really has, when you think about it really, really logically, it's not there. That being said, we know rental property. Yeah, go.
Well, I just wanted to add one thing.
Yeah.
I think there are other things that are a little bit more substantiated as to why you maybe might not want to invest in Florida. That aren't so closely tied to like a huge profit center. If I think about insurance, people have also gone off the rails about insurance in Florida. And I understand that more than I understand the property tax equation, because it's not like if your insurance goes up, you're going to have $100,000 of home price appreciation.
Yeah.
Insurance going up is just, it stinks when your insurance costs go up. And that has happened in Florida in the past. So if you just compare like the insurance conversation versus the property tax conversation doesn't make nearly as much sense to me, because it really is tied to home price appreciation, where insurance actually makes a little bit more sense.
It's not that you're like a true believer in rental properties and therefore you don't understand because you see the numbers.
Right.
It's because in this one in particular, property tax going up means
this. Yes.
That's appreciation went up.
Yes, exactly.
Right. Yeah. So that makes perfect sense. All right. So then like talk us through what actually happened here, GC.
Yeah. So let's just lean in and look at the numbers as far as the pain that people have felt with property tax increases. So what I did is I pulled the median home sales price in 2020 in Jacksonville, which my eyesight's not so good, Pops. What's the number there? 249,000 or so?
249,900.
249.9 was the median home sales price in 2020 in Jacksonville. And then what we look at is the average property tax percentage of the price, which is 1.3% in the state of Florida. That's actually a lot lower than a lot of other states as far as what their average property tax percentage is. So that's a great thing for the state of Florida. But if you look at that, then you could estimate what the average property tax bill is in Jacksonville in 2020. And again, I can't see the number there, Pobs. For an old man like me, can you tell me what that number is?
3,249.
There we go.
Yeah.
So $3,200. Well, then I looked in 2020. Then currently here. So our median home sales price right now, according to John Burns, is about $361,000. Our property tax percentage, again, is 1.3%. So, our average property tax bill was at about $4,600 or something like that.
Are you coming off of memory now, or like you're more focused on the lower thing here?
Kind of.
Yeah, I thought so. That's pretty.
I'm like tricking the eye doctor here a little bit.
Yeah, like really go over here. It's coming out of here. All right, yeah, I got it. Cool.
So, big picture, that means that the median home sales price in Jacksonville has gone up over 110,000, about 111,000.
111, yeah.
Which is the big picture win that the average investor in Jacksonville has received. But the average property tax bill has gone up about $1,400. And that's what really has hit people's bank accounts. And that is what drives a lot of these articles that are written and these headlines and say, oh my gosh, property taxes have gone bonkers in the state of Florida. People focus on that $1,400 number. There's no mention of the other number.
There is a certain feeling of like, puh, when you get a letter in the mail from the government saying you owe me more money.
Right.
Yeah. And that's very visceral. So like this idea this has happened over 6 years. So it's not like if like 1 year to the next, they're like, give me an extra $1,400, but like every year that happening, feeling that it's continuing to happen. Whereas your home price appreciation is much less tangible. Like, your net worth is going up. You know that this is real estate doing its thing. You know, you're going to be able to use that to have property babies and like all this other kind of like stuff. But that you don't get a letter in the mail saying, good news, your property just went up $110,000.
Right. And that 44% increase is substantial compared to what pro formas said in 2020. Nobody expected property taxes to go up 44% over the next 6 years. The expectation that we have on all of our pro formas is a 3% increase per year for property taxes. And so 3% time, compounding annually for 6 years is not 44%. It's a lot less. So the estimates for property taxes for everybody, including JWB, were lower than actuality when it comes specifically to property taxes. And the reason for that, of course, is because of the big amount of home price appreciation that we saw.
Got it.
But the other part of this, so I look at it and I say, okay, well, people are upset about property taxes going up. They're missing the big picture that their pile of money is a lot bigger. Their equity in their home, their home price appreciation, their net worth is a lot bigger. Like the amount of increase of property taxes hurts our pocketbook. Nobody likes to spend $1,400 a month, a year more. However, the amount of money that we've gained in this transaction is a lot more. But the other reason why I discount the property tax question or reason as to why not to invest in the state of Florida or in Jacksonville is because net income wise, you actually have gained included in the property tax increase. And what I mean is that rents have gone up a whole lot more than we expected since 2020. So in 2020, the median single family monthly rent in Jacksonville was about $1,440. That brings you out to about $17,000 in annual rent.
$17,000, yeah.
Well, in 2026, that same median single family rental property in Jacksonville has rents of about $1,800. So the total rent increase is 26%. That's a lot more than we expected when it came to your pro formas. And 26% on $17,000 is a much bigger number than 44% on $3,000.
Yeah.
Right. So you have gained a lot more in rental income to fully account for the increase in the property taxes and then some.
But you know what you haven't gotten, GC?
What's that?
Is a letter in the mail from the government saying your rent has gone
That's
up.
right. You have gotten a notice from JWB. If you're a JWB client,
Yeah,
you've gotten a call and you've said, hey, guess what? We've
Yeah.
now rented the property, or
Yeah.
your resident has renewed at a $50 a month increase or something. So there's a little bit of that, but yes, to your point, you don't get that.
Yeah, right. So it's just like a visceral feeling. It's totally understandable, right? Like it's like $1,400 that you're feeling versus this $4,400 straight up, right? Like at the end of the day, cash flow wise, you're up $3,000 cash flow out of your pocket.
Just on that, absolutely.
Yeah,
So
but it's not the same feeling.
it's not the same feeling,
Right.
and it hasn't made the same headlines, to be quite honest.
And there's no headline.
Right.
Yeah, correct.
And that we shouldn't simplify and just say, rents have gone up, which is outpaced what property taxes have gone up, because there's other expenses along the way. The other one that has made a lot of headlines is insurance cost as well. So here, I just wanted to put the big picture together for what the average investor, JWB investors, and even beyond JWB investors in Jacksonville have experienced through this potential time of maybe not wanting of the general public saying this is not a good time to invest in Florida because of property taxes. Let me tell you what has really happened. So from the years 2020 to 2026, the total increase for the average investor in Jacksonville has gone up by about $13,000 cumulatively? I can't see the number there.
13,200.
There you go. Going off memory there.
Yeah.
So all in all, over those 6 years, the average investor has made over $13,000 additional rent just from the rental revenue. Yes, revenue from the gains. Property taxes have gone up. So on average, they've had to give back about $4,000 or so.
$4,323.
$4,323. There we go. And then I also estimated for the increase to insurance as well. So I estimated that insurance costs had gone up about $500 a year. Mm-hmm. So now we can kind of look at this and say, all right, so rents are way higher. We gave about $5 or $6 grand back in terms of additional property taxes and insurance costs. We're still net income positive here. Mm-hmm. And this is why the argument as to why not to invest in the state of Florida or a market like Jacksonville because of property taxes holds no water with me. Yeah. It's because you win on the net income side. Yeah. You win on the net worth side.
You didn't even bring up the net worth side.
Right.
That you win on the net income side. So like year over year, you are like your revenue is outpacing the increase in expenses by a tune of $7,000, right? Exactly. Almost $7,500. And on top of that, your net worth has gone up an extra $111,000, exactly. Right? So like we're talking about in your pocket, an extra $7,500, but in what this means to your future and your retirement and stuff like that is closer to 120.
Exactly.
Yeah.
Exactly.
Pretty strong case.
That's why it doesn't make sense to me when people say don't invest in the state of Florida because of property taxes or don't invest in Jacksonville. You win even in a moment where property taxes went up way more than we all expected. You still win. The JWB investors who bought back in the day still won. I won, you won. And that's not a coincidence. Yeah. We talk about how you still will win in rental properties, even in downtimes. Yeah. Often. It's like a main theme of why I love this asset class. Yeah. So look at this. This is another feather in the cap of rental property investing. Even when property taxes go way up and insurance goes way up, it was still the great time, a great decision to be able to invest during that moment.
I didn't even think about it, man. Like just how many, as we are in episode 499, I wonder how many times we have said, hey, this weird thing happened over here that everybody thought was like this like momentous thing that would have like really derailed things. Mm-hmm. And look, we're actually coming out way ahead because as we talk about the risk mitigation inside the workforce housing, single family home in a growing market is so vast. Yeah. Right. Like we've talked about it. Pandemic, right? Like like everything shuts down, still a critical need. We've talked about it, higher than normal interest rates, people are still coming out ahead.
Exactly.
We've talked about it, insurance going crazy, still coming out ahead. We've talked about it now, property taxes going crazy, still out ahead. And now it's all of those things together, still coming out ahead.
Still coming out ahead. And now we're on the doorstep. If we go back to the original part of the show here, we're on the doorstep of potential significant property tax decreases.
Correct.
which is really interesting to think about. Again, the punchline there. If that should happen, guess what?
Yeah.
As rental property investors, you are absolutely going to come out ahead.
High floor and high upside investing class.
Exactly.
Right? Like I just don't know anything else that compares to this.
It's because it's a critical need for the family. It's a critical need for the local market, the community, and it's a critical need for the government.
That's the high floor.
Yeah.
And then the high upside is it has 5 profit centers that you can benefit from.
Yes.
And leverage.
There you go.
It's pretty awesome, man. Pretty awesome. So you also had a comparison of just what it looks like during normal times. Take us down a memory lane of one of your first rental
so we
properties.
just did an outlook where we fully leaned in and said, hey, you know what? Property tax increases were a lot higher than we expected. We missed on the pro forma if you're just specifically talking about that line item. And that was a time when property tax increases were just bonkers. All right. You don't typically get that level of home price appreciation. You don't typically get that, but it happened. But I thought it'd be good to bring it back down to what does it look like for normal property tax increases? Because we know that taxes and insurance and other costs are going to go up as you own these properties longer and longer. It's really easy to account for that because typically those increases fall within a small range. And we just tell you to expect that in your pro forma. We build it in over a 10-year model, and then you know what to expect. And more importantly, your returns happen just like we told you they would. So I thought it'd be good for you to see one of my own rental properties. This is a property I bought in 2006. I still own it today. It's 345 Duray Court here in Jacksonville, Florida. And I went back to a time when things were less bonkers. I pulled the actual annual property taxes in 2014 and then in 2019 before the world changed with COVID. And so what you see is the property tax bill that I had in 2014 was $785 a year. In 2019, it was only $907 a year. That came out to about a $24 a month, $24 a year average increase for property taxes, which if you annualize that comes out to 2.9% per year. On our evaluations, we tell you to expect 3% for property tax increases year over year, because that is the average that we have seen for decades here. So this is really what you should expect long-term when it comes to property taxes in the Jacksonville market. And this is, I think, how you can have confidence to know that the pro forma that you have already has the expectation for taxes to go up. And when they go up, you're going to win, along with the fact that if something abnormal happens and they go up by a large margin, we also know that we win. Although that just really, I think that was a very special moment in time during COVID. And I just don't see that happening again sometime soon.
Really good overall presentation. I'd love to just kind of like talk in general about taxes, right? So this is the explanation of a moment in time where there was like these particular things that were happening, namely super high home price appreciation, right? Like which made that happen. There's a couple clarifications here. There was a slide there where you said that you were dividing something by 2.
Yeah.
Right. Why were you dividing it by 2?
So what I did is I took all 6 years of that increase in rents. Let's just say, I think it was like $4,000 or $5,000 a year of increases just of the rents. Yeah. And the best way I could do this to average out what the impact would have been is to assume that happened halfway through the ownership. So it's almost like an easy way to average out the effect of it. So I basically took 6 years times whatever that number was of, I think it came out to like $28,000 with the total amount of revenue increase. Yep. And then I divided it by 2 to kind of average it out, because not all of those revenue increases happened immediately day one. Got it. They didn't happen at the very end. So I just assumed that there was a gradual increase along the way. And the best and easiest way to do that is just to divide by 2. Got it.
And you divided by 2 on all the properties. So that just like went through. So either way, you could like double it or whatever. It's still the same ratio.
Exactly. I could have taken the cumulative increase overall, but then I would have been assuming that all that happened day 1 in 2020, which wasn't real. So this was the best and easiest way I thought to be the most accurate I could.
And we have an anonymous attendee here that's asking, an explanation of the past is fantastic and looks amazing. But with regard to this, how would taxes/insurance affect appreciation and the pro forma moving forward, say 1 to 3 years, knowing that will affect the 10-year cycle?
Okay. I want to make sure I'm answering that. There's a number of different caveats. So if I missed something, help me out here. Yeah. We looked at the past. Now we're projecting for the future. We build in our expectation of what home price appreciation is average home price appreciation is going to be. We build in our expectation of what annual property tax increases are going to be.
Yep.
And so that's really simple. It's really not rocket science to do that. We use the average annualized home price appreciation rate over the last 40 plus years. And the same thing when it comes to our property tax increases as well. So really not hard to project what will be happening over the next market cycle when it comes to property taxes and it comes to home price appreciation. We don't always know what's going to happen though. So your property taxes may go up over the pro forma. They may be lower than what the pro forma is. Your insurance may be higher. It may be lower. I can't guarantee any of that. I never would claim to do that. We are not going to be spot on. But I think the takeaway is when one thing goes higher, does something else also happen to your benefit to absorb that higher cost? And what we have seen in every market cycle, even when there's an anomaly like high property taxes and high insurance costs, well, there was something that was driving that really is to your benefit. And rents also go up and home price appreciation also went up. So even in those environments, even if the pro forma is wrong when it comes to property taxes over the next 10-year cycle, because you're investing in an asset class which has so many risk mitigating factors, it's very likely that you're still going to win. It just might not be the exact way that it's on that pro forma. Do you feel like I answered the question there?
Yeah, that makes a lot of sense. I'm going to dig in a little bit more.
Okay.
By the way, the chat today has been really funny.
Yeah.
Like they're it's been really funny of them like poking fun at like the set design and like different things. I happen to catch Leslie Wilson saying this set design is interesting because Pablo's in a leather chair and Gregg is sitting on the sofa getting analyzed. Pablo has always wanted to get inside Gregg's brain, and this set definitely helps.
Should I just like lay down here?
Yeah. So that's a little much, Gregg.
Right.
So let's dig deeper into this feeling, Gregg.
Okay.
I think the point taken, the first thing that pops out to me in that question is, whatever happens in 1 to 3 years is really not something that we think very much about as long-term buy and hold investors.
Sure.
We're thinking about what happens over 10, 20 years, right? Like this game is a buy and hold game over at least a market cycle, 10 to 20 years. And therefore, the best thing that you can do in order to predict the future when it comes to like something that gets flattened out over 10 to 20 years is look at cycles from the past and how it continues to repeat itself. And one of the big themes of the show is this idea that no matter what has happened in the short run, in the 1 to 3 year window, something also happens within the 10 to 20 year window that normalizes it and pegs it back to this historical performance of this asset class. It's the reason why you guys, being in business now 20 years, haven't had anybody lose money. You've generally over delivered on all these performance and all these different kinds of things. And what we are saying is this is another example of that, right? So I think while the anonymous attendee is looking at like, yeah, cool, that's what happened in the past. I think that's something I feel like I always bring up to you when we're talking about it. It's like people aren't so worried about like what happened in the past. They want to know what's going to happen in the future.
Sure.
And I think the general thesis of the way that JWB Investing has built wealth for people is that like nobody knows what happens in the future, and our best predictor of the future is a normalized analysis of the past when you're looking at a long-term market cycle. And that's why this asset class is so good. It's because we're looking at it in really big, wide year chunks, and they continue to repeat. So like the answer to that is like, yeah, that we saw this blip, this just happened. And in this blip, it didn't matter.
Yeah.
and it's going to matter even less in the overall cycle of it all, because you continue to win, because this is a diversified asset class that when something kind of like goes down on another, on one side, something else goes up on another side. And you continue to have this like return that continues to be consistent on all sides.
Yeah. And I think it's important to think about worst case scenarios. And so a worst case scenario for rental properties is probably something that I experienced, many people experienced probably on this call during the Great Recession.
Yeah.
Right. So thinking about what really happened there is probably the worst case scenario, and think about what happened to your rental income and your cash flows. And then compare, because nobody knows what's going to happen in the future, compare where else you're putting your money to what really happened during those worst case scenarios.
Yeah.
And the reason that keeps me bringing me back to rental property investing and why I bring my friends and my family and all of you, into this asset class is because in a worst case scenario, usually the scenario that I find myself in as a rental property investor is better.
Yeah.
It's better than most,
Yeah.
and that's when things go off the rails.
Yep.
When it goes on the rails, it's steady, it's consistent, it's reliable, it's there to build a great financial outcome for you when you need it. So I think while we don't know exactly what's going to happen in 1 to 3 years, I feel really confident investing in a hard asset that people need a roof over their heads, that I understand it, that the government is incentivized to make sure that it works. And that's, what brings me back.
Agreed. Good stuff. GC, what's your overall thought about how important property taxes are to the mix?
Especially over the last year and a half, there's been so much noise about it, and it's just not ever something that really hits the radar for me when I'm thinking about buying a rental property. There are so many more important things to be thinking about when it comes to investing in rental properties than property taxes. Your property taxes are in the state of Florida on average is 1.3% of your purchase price. That's relatively small expense. The bigger things to pay attention to are what's actually driving your profits. Your profit centers are not made equal. Property taxes is a very small component of a small component of your profits overall. Yeah. So for me, when I'm thinking about how can I engineer the best rental property portfolio, I want to see what's making me the most money over a 10-year hold. And I want to put my attention and make sure I'm taking care of number one first. Mm-hmm. Property taxes is a relatively small component of it. And the variability of it is relatively small, typically as well. So I think there's been way too much talk about Florida property taxes being high or whatnot because of the reasons we talked about earlier. And I think more people should focus on what really matters. The number one thing that matters is the team, because this asset class is great if you are in for a full market cycle. If you do not like the team that you're working with because they are not worthy of taking care of your money, well, it doesn't matter what property taxes are or what home price appreciation or whatever is going to be. You're just not going to last in this asset class. You're going to be like the average investor out there. You're going to maybe never start. If you do, you're going to get upset because of the experience and you're going to move on. So number one, you should be focusing on the team. And then number two, you should be focusing on the market. And the reason that number two is the market is because your biggest driver of profits is home price appreciation. That's the profit center that actually delivers the most wealth for you. So in that vein, I think talking about property taxes should be a relatively minor part of the decision when it comes to investing in rental properties. I'm surprised that it has been thrown out there as a reason to not invest in the state of Florida. I feel like there's some miseducation there, because on the other side of property tax increases is a huge pile of money of home price appreciation, which is the reason to invest in a city and a state that is growing in population like Jacksonville in the state of Florida. So now when we're talking about potentially eliminating property taxes, this is where I think it's definitely worthy of a discussion and something to pay attention to. But outside of that, understand what your property tax base is. More importantly, understand what your net income is, your cash flow is, and then focus on the most important things, your experience, the team that is leading your investment for you, and making sure they're in a market where population is growing. If you put your energies there and you get that 97% right, you're going to be so much farther ahead than if you spent 90% of your time thinking about property taxes.
That was really well said, man.
Yeah.
I'm like, there's some moments where I'm just like watching, I'm like, dude, Gregg is just wheeling and dealing out here. That was really well explained. I want to try, that's a very Gregg answer of like knowing everything that you're talking about. And it oozes expertise and data and perspective and all these things. I communicate differently.
I loved how you were setting me up there. I couldn't wait to see where you were going next.
I communicate differently. As we finished our run today, I was like, let me throw something out there to you. And I threw it out there and you kind of looked at me funny. I was like, save that for the show.
Yeah, true.
Right. So let's,
what was that? I can't remember what you said.
Well, you're about to find out. You're about to find out. So I've been thinking a lot about this idea that, in most other asset classes, I'm expected to contribute and contribute and contribute. And it's always like coming out of my pocket and into, right? Like it comes out of my lifestyle and like my delayed gratification, but like ideas and into it. And yet in real estate, I kind of like just put something in, it just works because it pays for itself and it grows and it does all these things. And on the rare occasion, like there is a certain things, right? There's maintenance, there's taxes, there's insurance, right? There's these like costs that are part of it that we make this like big deal about. But for me, I've just started seeing those expenses and seeing those payments in. Like I have a turn coming up, and like in my head, I'm just like, oh, cool. I might pay $4,000, $6,000 for a turn, big number,
Right.
But how is that any different than like the money that I've been taking out of my paycheck to put into my 401k over the last 2 years, just coming out of my paycheck, right? Like, so I've started thinking about it that way, and specifically, and I compare it to the 401k thing because the 401k thing is tax advantage. So is this, right? Like, isn't like these are all things that are also reducing my tax base. So like even every dollar that I'm like taking out to put this back into my property, I'm seeing it as just kind of like a deposit into myself and a deposit into like my savings account that is also leveraged, that is also tax deductible, that's just doing all these things, right? Like, where am I wrong there?
You know what? I think what you just said there is beautiful. I really do. It's interesting because when I was growing up, my dad would always talk to me about paying myself first. And there's different ways that you pay yourself first, right? You can save money at the end of the month and, and all of that. For me, as I started to join the workforce, it was very clear that paying myself first was making sure I contributed to my 401k, maxed out my contributions to my 401k, and maxed out my contributions to my IRAs and, an HSA. And so that was paying myself first. Well, you're applauded for continuing to contribute when you are paying yourself first. You are contributing to your 401ks or your IRAs. But it's interesting that you bring it up that way. I've never heard you explain it that way. I've never explained it that way, but it makes complete sense because in that regard, you're paying into you're contributing to your retirement account. Yeah. It's a tax advantaged account. What you're doing with rental properties, in a worst case scenario, if you do have a big expense, you're contributing.
Yeah. Every couple of years.
Yeah, every couple of years.
Right?
I just think it's about expectations. Yeah. Because in rental property investing, the expectation is that you don't go negative. You are cash flow positive. Yeah. But the point that you're bringing up is that if that's not the case, if something out of unforeseen happens and you go negative, you're still probably better off than the contribution amount that you put towards your 401k.
Yeah.
Yeah. No, I dig it. I think that is a mental shift that I don't think we've talked a lot about on the show, but rings true.
Yeah. Yeah. And even when I said it, your first reaction was like, oh, about capital calls or, can't call it a capital call, but this isn't a capital call.
I think I missed the point of what you were saying this morning. As you said it there, I was like, oh, and that's what he's talking about. No, he is 100% right. It's a different frame. It's a different, different mindset. But at the end of the day, if you look at the blocking and tackling of what you're doing, you're contributing a certain amount, your thousands, into an account that is tax advantage and you're hoping will grow. Well, you're getting all that with rental properties. You just have the ability a lot of the time to not have to go negative. But don't lose sight of the comparing that to the other things that you're already doing that you're applauded for over there,
Yeah. Yeah. And like, not to beat a dead horse on this, but like, if I keep thinking about it, I'm like, people get super pumped about like an employer contribution into a 401k being like a 50%, 20% match.
Yeah.
This is like contributing and getting a 150% match if I'm leveraged, right?
Yeah.
Like if I have a 20% down and I'm making money on like the leverage of it, like it's a all the way around. It's a tax deduction. So the dollar that I'm putting in is not dollar for dollar what I'm putting in.
Right.
And on top of that, what I'm putting in is growing at like a leveraged in a leveraged way.
100%.
And I feel like there's so many people that churn out of this asset class because of the emotion of like, I can't believe I got to take money out to put this thing in when I've already put this thing in, but there's no other vehicle where you're not asked to do that. The crypto bros are like, keep dollar cost averaging into Bitcoin.
Right.
Like your financial advisor is going to say, continue to like pay into the market, time in the market, right? Like,
Yeah.
whereas real estate, it's like, no, you pay once and then forever you get returns. But like, no, man, you continue to pay, and it's actually tax advantage and it's leverage, and it's really, really good. And I think like that mindset shift as I'm headed into my next turn, which I haven't had a turn in forever. So I had to like be like, oh, okay, I got to spend some money here. But I'm like, no, wait a minute.
Yeah.
Like, I don't know, man. It's just some that like Marta and I have been like talking about.
No, you're 100% right. I think that mental shift right there is really meaningful. I'm really glad you brought it up here to talk through it, because I think that will help people understand the good decision that they're making in rental property investing, even when you have an unforeseen negative thing, right? And just comparing that to the other things that you're doing that you feel really good about. Usually when you go through that comparison there in your own head, you'll realize that what you're doing over here on rental properties, really not that bad. The other thing I would just add there,
Not that bad. Pretty freaking good.
pretty freaking good, even when you have an unforeseen thing. I think the thought process is really powerful that you just talked about there, the reframing of it. And then I think there's just like a blocking and tackling thing that you can do to make sure that you do not feel the physical pain of losing money. And that is just having reserves.
Yeah. Hordening off a section of capital where
Exactly.
it comes in and out, and you don't have to like feel like it's coming out of your lunch.
Exactly. Because what we know is, even when you have an unforeseen expense, it's not that it's going negative for a long time, right? It's a temporary situation that is going to have a surplus coming back as soon as that home is rented again. Yep. And while you might have, have $2,000 or $3,000 of an expense, that's temporary. That new renter is going to come in, it's going to make up that expense, and then all of a sudden it's going to grow from there. So it's like you need to have that temporary kind of quarantined off holding cell of money that is like a temporary bridge loan, in a sense, that you're giving to yourself. If you can match the mindset that you have right there, where we understand that in unforeseen times, sometimes we do need to make a contribution to rental properties, and to be good with it and realize all the tax advantages and the growth and the leverage and all of that. Yeah. And then physically just have reserves set aside so that you just literally move money from one account to take care of it. It doesn't come from your personal bank account that you're spending groceries on. If you do both of those things, you are going to be so well off, and you're going to last in this asset class, and then you're going to benefit from it as it gets to retirement or whatever your financial outcome.
I think we're going to need to drop both of those speaking points once the studio is ready and I don't look like I'm a flushed out ghost.
This is good. We're trying some new material out today too.
Yeah,
I like it.
What's the horse walks into a bar? Before we get out of here, we had two questions from a couple of community legends, which are kind of related. Leslie Wilson, the maven from the mountains of Denver, says, I thought the Florida property tax relief was just for homeowners and not landlords, correct? And then Michael Santorios, patron Santorios of the Natural Average Investor community, says, Gregg, if cutting property taxes attracts more residents to Florida, doesn't that just increase demand for workforce housing and put upward pressure on rents? I think those things can be answered kind of together.
Yes. So to answer the maven's question, the reduction or elimination of property taxes is only for primary residences. So it is not for landlords. Our property taxes would stay the same, or would be whatever it is. It's not going to eliminate that. And the way that we would win there is because if primary residences all of a sudden have a much lower cost of living, and you have demand coming from continued population growth in Jacksonville and in the state of Florida, all of a sudden that new homeowner that is just going to go and buy a house, all of a sudden they can qualify for $20,000 more or $30,000 more because their property taxes are a lot lower and their income can justify a higher loan payment. So that would immediately happen as soon as this was implemented. And so all of a sudden you're going to get that same swath of buyers in Jacksonville are going to have $20,000 more purchasing power, or whatever it is, $40,000 more purchasing power. And that's why you're going to see home prices go up on primary residences. But it's not just primary residences that home prices are going to go up, because the way that our properties are valued is based on what else is selling in the neighborhood. And it's not just primary residences versus rental properties. We would benefit because our home values would be influenced by other primary residences that now had so much more buying power and would sell at a much higher price. So think of it as a temporary shot in the arm to home price appreciation for you as a rental property investor if this was to go through.
And it would make sense to be owning before that happens.
And you want to own before that happens, because you know what's going to happen is on
Yeah.
the other side of this, that temporary bump to appreciation will happen.
Yeah.
At some point. It's going to meter out, because we're then going to get back to a place where affordability is a challenge,
Yep.
except home prices will be up here now.
Yep.
And you could have benefited just like the Maven has. She owns many properties, right? And just like others do, you will have benefited if you bought now, then waited until afterwards.
Yeah.
It will just be like every other good time to buy
Yep.
later down the line.
So if you want to do that, chat with jwb.com.
There we
Gotta
go.
throw it out there.
There we go. And Michael Santorius' question, just talking about,
Same thing.
Same thing, right?
Have an upward. He was just
Exactly.
verifying what you were saying.
Yeah, 100%.
Yeah,
Same logic applies.
Yeah, totally. Good job on the show today, man.
Yeah, man.
I'm glad that we did. So Lee came in late, so he didn't realize that we were doing like a friends and family night, testing out this studio. So he's got a whole bunch of notes here.
I love it.
But I'm glad that we did it, because now for the 500th episode next week, we're gonna have all this stuff dialed in.
Yep.
I promise you, it's gonna look totally different, but really good friends and family night tonight.
This is great.
It was just great. Good topic, man.
Yeah.
Way to prepare that presentation.
Of course, man.
I thought that this worked out really, really well. Really excited for the 500th episode. We got a bunch of really cool stuff, ready for people to take a little stroll down memory lane of the things that we've been through, the things that have made this show great. 500 episodes, man. I'm going to be deep in thought about like what that means for all of us for the next week. But from now till then, GC, you got any pieces of advice for anybody?
Don't be average.
Don't be
Be
average.
everybody.